Let me ask you something. What if I told you about a stock that just collapsed? I'm talking a gut-wrenching nearly 60% nosedive from its recent highs. A company drowning in multiple class action lawsuits. A company that last quarter pulled in a jaw-droppingly tiny $500,000 in revenue. If that's all you knew, you'd probably lean back, cross your arms, and tell me this thing is a dead stock walking. A terminal short. And honestly, you'd be completely justified in thinking exactly that. But here's where the story cracks wide open. What if I also told you that one of the most ruthless calculating hedge funds on all of Wall Street just quietly scooped up over 10 million shares of this exact company? While everyone else was sprinting for the exits, the smart money was backing up the truck. So the real question, the one that's been lighting up trading forums everywhere, is this. After a 60% crash and a mysterious 10 million share buy from Citadel, is a violent short squeeze the next thing on the menu? Welcome to the wildly polarizing, absolutely electric world of Poet Technologies. Today we're going to unpack the crash, decode why the smart money is moving in, break down the exact short squeeze mechanics, and reveal the tactical setup that has traders on the edge of their seats. If this kind of deep dive breakdown is what you're here for, do me one quick favor and smash that like button and subscribe. It genuinely helps this channel bring you more no-nonsense market analysis. Now let's get into it. To understand why the so-called smart money is diving in while retail investors are panicking, we can't just stare at a falling price. We need to look at what's actually happening underneath the surface. So let's set the stage. Right now, Poet is trading at around $8 a share. That's down a brutal 55 to 58% from its 52-week highs set back in mid-May. Let that sink in for a second. More than half the company's value gone in a matter of weeks. That's the kind of drawdown that makes even seasoned investors feel physically ill. But here's the pattern interrupt, the thing that stops you dead in your tracks. Zoom out from the chaos, widen the lens, and you'll discover something wild. This stock is still up over 35% year to date, and over the trailing 12 months, up an astonishing 74%. So which is it? A catastrophic failure or a rocket ship that's simply catching its breath? The answer lives in the volatility. We're looking at annualized volatility running between 123 and 128%. Read that again. This isn't just a stock. This is a violent, white-knuckle tug-of-war, massive, aggressive AI infrastructure ambition on one side, and genuinely terrifying execution risk on the other. And those risks, they aren't just theoretical fears whispered by nervous analysts. They've already drawn blood. Let's rewind to April, because this is where it gets brutal. In a single savage trading day, the stock cratered nearly 47%. Almost half its value wiped out between one opening bell and the next close. So what on earth happened? Marvell Technology, a heavyweight partner, abruptly canceled all of their purchase orders. Why? Because Poet's own chief financial officer allegedly breached a non-disclosure agreement during a public interview, leaking sensitive shipping data straight into the open air. But the pain didn't stop there. Pile on top of that multiple securities class action lawsuits. These suits allege the company misled investors about its U.S. tax status, potentially labeling it a passive foreign investment company. And if that designation sticks, it carries a genuinely nasty tax surprise for U.S. shareholders. Then comes the final gut punch. To keep the lights on and fund its ambitious operations, Poet raised a staggering $830 million in equity capital over the past year. And what does that mean for existing shareholders? Dilution. The absolute life diluted right out of them. So at first glance, this looks like an open and shut horror story, right? A company bleeding cash, tangled in lawsuits, betraying its own partners. But hold on, because there is one single number that completely flips this entire narrative on its head. On July 8th, Citadel Securities, yes, that Citadel, Ken Griffin's legendary trading empire, disclosed a massive 5.8 to 5.9% passive stake in the company. That's over 10 million shares, scooped up, quietly, right as the entire market was screaming and running for the doors. And this forces us to ask the question that just doesn't make sense on the surface. Why would a firm this sophisticated, this surgical, touch a company that generated a mere $503,000 in first quarter revenue, while simultaneously posting a $12.3 million net loss? Here's the answer, and it changes everything. Because the market isn't pricing Poet on what it did last quarter. It's pricing Poet strictly on what it might do tomorrow. It's all about the forward-looking pipeline. And that pipeline just got a lot more interesting. The company recently announced a $500 million supply agreement with Lumalens. $500 million. And they're aiming to ramp capacity to 1 million optical engines per month by the end of 2027. And when you look at the valuation through that lens, something jumps out. The stock currently trades at what looks like an undervalued 3.3 times price-to-book ratio compared to the 5.5 times average across the U.S. semiconductor industry. On paper, it looks cheap, but, and this is critical, that valuation leans entirely, completely, on that future pipeline actually becoming reality. It's a bet on tomorrow, price today. So before you get swept up in that distant, shimmering future, there's another layer to this. And this one creates an immediate, highly explosive setup happening right now, in real time. Technically speaking, POET is trapped in a violent squeeze. It's currently pinned below both its short-term 20-day and 50-day moving averages. And historically, that's a bearish, ugly sign. But here's the twist. At the very same time, it is fiercely defending its critical long-term 200-day moving average, which sits right in the $6.75 to $7.85 zone. So we've got bearish signals stacked on top of bullish support. A battle in real time. And the momentum? The relative strength index is hovering right around 39.8. What does that tell us? Momentum is cooling hard, sliding toward oversold territory. And yet, here's the head scratcher. Despite all this bleeding, despite the lawsuits, despite the crash, Wall Street analysts covering the stock still maintain a strong buy rating, with an average price target of $17.50. Think about that. The stock trades at 8, and the pros are calling for $17.50. Are they delusional, or do they see something the panicking crowd is missing? And that brings us to the one metric that traders obsess over when a stock gets compressed this tightly. The metric that turns a slow bleed into an absolute explosion. Short interest. As of late June, over 27 million shares of POET are being sold short. Let me put that into perspective. That's a staggering 17.73% of the entire public float. And it's climbed massively, up from just 12.4 million shares back in mid-April. So in a matter of weeks, the shorts have piled in, doubling down, betting big on this thing going lower. But here's where it gets truly juicy. When you pair that mountain of short interest with the July 17th options chain, a fascinating, almost cinematic picture emerges. There's a massive brick wall of put options sitting at the $7 strike. Over 11,000 contracts stacked up. And what does that create? A tremendous structural floor beneath the stock. A safety net woven right into the derivatives market. Meanwhile, the $8 level? That's the battleground. An absolute war zone where bulls and bears are trading blows contract by contract. And on top of all this, implied volatility has been crushed down to the lowest second percentile of its entire annual range. In plain English, options are dirt cheap right now. Historically cheap premiums, at the exact moment the stock is coiled up like a spring ready to snap. When everything is this quiet, this compressed, it usually doesn't stay that way for long. So taking all of this in, the crash, the Citadel buy, the short interest, the options wall, what exactly is the actionable play here? Let's talk numbers. Historically, when POET trades this closely to its moving average extremes, under these exact volatility conditions, something remarkable tends to happen. It bounces higher 86% of the time over the following month. 86%, with an average gain of nearly 25%. Now, past performance never guarantees the future, but that's a pattern that demands attention. So if you're eyeing a tactical, short-term, long setup between July 14th and July 17th, the math points heavily toward the upside. The entry zone sits right here, between $8 and $8.15. Your hard stop loss? A daily close below $7. Because a close below 7 shatters that massive put wall and invalidates the entire thesis. But if that 200-day moving average holds firm, the initial resistance and first target lands at $9. And here's the scenario that has everyone buzzing. If a short squeeze actually ignites, if those 27 million shorted shares are suddenly forced to cover all at once, the stock could get violently pinned straight up to the $10 call wall. Imagine that cascade. Shorts scrambling, buying to close, driving the price up, forcing even more shorts to cover. A feedback loop of pure momentum. Is it guaranteed? Absolutely not. But is the setup there? 100%. All right, let's bring this all home. Before we do, a quick but important note. Everything discussed in this video is for informational and educational purposes only. It is not financial advice. I am not a licensed financial advisor, and nothing here should be taken as a recommendation to buy or sell any security. Trading and investing carry real risk, including the potential loss of your entire investment. Always do your own research and consider speaking with a qualified financial professional before making any decisions with your money. Okay, Okay, with that said, let's wrap it up. So what's the final verdict on POET Technologies? Let's separate the two timelines. Long term, make no mistake, POET is a highly speculative, high beta gamble riding on the AI supercycle. For the fundamental investor, the line in the sand is clear. If this company doesn't start realizing substantial revenue exceeding $1 million by the fourth quarter of 2026, it becomes fundamentally uninvestable. Full stop. But, and this is the whole point, markets aren't always about fundamentals. Sometimes they're about mechanics. And right now, from a purely structural standpoint, POET is heavily de-risked. Look at the confluence. The 200-day moving average support holding strong, historically cheap options, a massive $7 put floor acting as a safety net, and sudden, unexpected institutional backing from Citadel itself. Together, that creates a genuinely favorable risk-reward asymmetry. So while the core business is bogged down in litigation and losses, the short-term mechanics simply lean toward a tactical long bounce, aiming for that $9 to $10 range heading into July options expiration. Now I want to hear from you. Here's my question, and I genuinely want your take in the comments. If a firm as sharp as Citadel is buying while the crowd is fleeing, do you trust the mechanics and ride the potential squeeze? Or do you trust the fundamentals and stay far, far away? Drop your answer below. I read every single comment. And if this breakdown brought you value, if it helped you see this stock in a way the headlines never could, smash that like button and subscribe so you never miss the next deep dive. Until next time, trade smart, manage your risk, and keep your eyes on the mechanics.